Hello, Baker Investment students. It is Sunday, April 24th, Sunday morning, so I hope everyone's doing well and had a good weekend. Um, can't believe we're already week 3, so these courses again move so quickly, so just stay on top of things. For this week, you're going to read chapter 5 to 6. It's a little bit of a technical read, especially in chapter 5, so just make sure to slow down, read a section, take notes, and reflect on what you just learned. You have the forum discussion, continue with those. You guys are doing a great job. And again, if you want to post a little bit earlier, like maybe end on a Thursday this week, look at your performance. That way you can have more time over the weekend to focus on other things like your quiz. Feel free to do that. Just make sure to have quality initial post and 2 quality follow-up posts to at least 2 of your peers. So, and again, if you have any questions, do reach out and email me, and I'll get you back to that following day at the latest. So, well, with the markets this past week on Friday, the news of a 50 basis point rate hike by Jerome Powell really shook the market a little bit. But in some ways, this should have been anticipated because inflation is really getting out of control. And the Fed wants to make sure that's in check because that can have wealth effects. So if inflation is 10%, you're only getting a 4% raise this year, or not even that, it really makes things distorted and worse off. So they recognize they got to get this in control, put the brakes on. So don't be surprised we see some more rate hikes. And generally with rate hikes, with the stock market, that's not good because that means that borrowing costs go up. And it's harder for corporations to borrow money, and then it also makes it harder for consumers that buy those goods from the corporations to buy those goods. So that usually means that revenues and earnings tend to go down. But it's important, so we do have to get this in check. So we're probably going to continue to see additional rate hikes this year. So with this week, Chapter 5, as I mentioned, it's a little bit more of a technical read. You're going to look at modern portfolio theory, but I think you're going to find something very fascinating and interesting. The main idea is that if I have this portfolio of stocks, I need to understand the risk associated with this portfolio. And we look at risk with standard deviation. So standard deviation is simply the square root of the variance. Variance, the idea of how far does it move away from an average of those returns. So if there's a lot of movement away, that's the greater risk. That means your portfolio can go up and down and up and down. And you'll probably see that with some of your stocks that you're investing in during a brief period of time, that some have a lot more volatility and some stay relatively the same. And with that, you're going to look at certain things like the idea of correlation. Correlation is essentially a number between -1 and +1. If it's at +1, the stocks are perfectly correlated, so they move with each other, which is not necessarily a good thing. You would want them where they have a negative correlation. That's not always ideal because the stock market generally moves up. Stocks are going to go up, the company-specific stocks, or it goes down. There's going to be some systemic risk, if you will. But you can diversify away company-specific risk. And that's why I encourage you to watch the video by William Sharp. He's a Nobel Prize winning in economics with his idea of the capital asset pricing model. Kind of a little revisit from finance. And it says if we take, for example, the risk-free return like a treasury bill plus beta times the expected market return minus the risk-free rate. So the idea here is that investors are looking for companies that can beat that opportunity cost, whatever it's set. But again, it uses beta as a foundation for determining risk. And beta is simply a measurement of how my stock performs with return-wise, price movements, dividends received, relative to the S&P 500. So as the S&P 500 changes, the independent variable, what happened to my stock return over that period of time? So if you have a beta equal to 1, it says if the market goes up 10%, then my stocks went up 10%. If the market went down 10%, my stocks went down 10%. But if you have a beta equal to 1.5 or greater risk, it says if the market goes up 10%, my stock goes up 15%. But if the market goes down 10%, my stock goes down 15%. So it kind of gives you an idea of volatility. So you're also going to read about portfolio beta, and that's one of the things that I want you to do in the forum discussion this week, is you look at the weight or the percentage of you own of that stock, the proportion, times that beta. Now you could find the betas if you go to Yahoo Finance, or if you go to the subject guides in Baker at the library and look for those stocks. They should have that. But for like one that I looked up this morning, for Evergy, it was at 0.50. So it has less risk to the market, so it doesn't move as much in the market, but it also means it doesn't make as much money either return-wise relative to the market. It just means it's a steady return over a period of time. You're also going to look at modern portfolio theory by Markowitz. He was one of the rock stars in finance from the 50s. Again, it's this idea of combining certain stocks in a portfolio that you can create an efficient frontier, if you will. There's feasible returns, but some have less risk than others. So anything on the line is less risk. And based on what we use in economics or utility theory, what we call indifference curves, an investor would pick that highest indifference curve that would maximize their level of happiness based on the amount of risk that they're willing to take on. So ideally, we'd want to be at that point that is the highest maximum utility and maximize our returns while reducing our risk. So you're going to read some about that. Finally, in Chapter 6, you're going to look at the stocks. This is a little bit easier to read chapter in Chapter 5. Chapter 5 can be a little bit technical. So again, as I said, just slow down, take your time on that to understand that. But you're going to look at some of the pros and cons of stock ownerships. Obviously, look at historical returns. Stocks can provide better returns, say, than a U.S. Treasury bill, note, or bond, something what we call like a risk-free rate. But there's also a lot of volatility, like we saw in the crash of 2008, where some people lost half their wealth. I remember my mother-in-law, she lived next door at the time. She bought the house next door, literally. She was in Estes Park, Colorado, and was able to sell her condo for a pretty penny and bought the house next door. But during that time period, 2008, she was near retirement, had like $1 million in her portfolio. She lost about half of that. So it was such a big shock. And that's kind of, as we have to look through our different periods of our life and where we are, how much risk can we take on, with the assumptions that the stock market in the long run is still going to provide better returns. For simply, if you just look at something like the S&P 500, that probably averages a 10% annual rate. But again, this doesn't mean 10% every year. It means some years it's up 30% and some years it's down 20%. So there's a lot of volatility with that. You're going to learn a little bit about dividends, how they're paid, like on an ex-dividend date. That's one thing I'm going to encourage you to do. Some point, look and see if any of your company stocks have paid a dividend, and if it has, just put that back into your cash account or buy more shares of that stock. Usually you can look at things just like dividend history, NASDAQ dividend history, and it will tell you when the last time a dividend was paid and what was the amount per share. Like for example, on Evergy, I think they pay 57.5 cents a share. So every share that you own, if you do 1,000 shares, you'd multiply that by about 50 cents, and that's how much you'd receive in a dividend. And most people just reinvest those dividends into purchasing more stock, or if you're retired, you may just use that dividend as a source of income. But you're going to learn about the payout ratio. Companies obviously make profits. I like to call it the soup. And there's many shareholders out there, I like to call them the spoons. So they can decide to retain some of those earnings. I think for Evergy, they probably make $2.50 per share on earnings, but they may only pay out $1.50 of that a year, or $2, something probably closer to $2 actually, at a 50-cent dividend. So they're paying out most of their dividend, but some companies do retain some of that soup, if you will, and not give it to the spoons, the shareholder owners, because they have viable projects they want to plow back into, whether it's windmills for Evergy, or trying to make the plants more efficient. So that's essentially, in a nutshell, the chapters 5 and 6. So again, if you do have any questions, do email me if you need to meet via Zoom. One thing I'd like to do is for our class, even though it's a small cohort, maybe consider one night, whether during the week or on a weekend. It's Sunday. Sunday might be good. May not be good if you're trying to work on everything. I have to think through that. But just to see if we get our cohort together and we can kind of go in a little bit more depth if anybody wants to about theory of investment. So, but again, I hope you have a great week. I hope portfolios go well this week. We'll see what happens. The world's a little bit of a crazy place right now with Russia and Ukraine. So there's a lot of uncertainty, but hopefully somehow that will get settled. Take care, and I'll talk to you online.